Here we are, and we're going to discuss how we present and analyze liabilities contingencies and what the importance is of these. As we all are aware, the financial statements are a means of communicating with a variety of stakeholders, be they investors, lenders, creditors, stockholders, analysts, governmental agencies, regulatory agencies, taxing authorities. Our financial statements are our means of communication regarding not only the operations of the company, but also the financial position of a company at any given point in time. The balance sheet is that snapshot picture, the financial position of a company at a specific point in time. And liabilities play an important part of that. Now, we have discussed how our current liabilities are typically presented at full maturity value. The reason for this is because the difference between the present value, time value of money, our favorite friend, and the maturity value are really considered immaterial because that time frame is so short. When we are presenting um, our liability information, not only in the records of the accounts, but also in the notes and additional disclosures of the financial statements, we need to be sure that there is an adequate, detailed, and supplemental information to meet full disclosure and transparency. The accounting profession, not necessarily the accounting profession per se, but let's just say corporations have taken a really big hit on transparency over the last several decades. Transparency became a huge factor following the early 2000s and the accounting scandals and bankruptcies that resulted in that period of time. Is part of what brought about the regulations that we adhere to and the new governance that was enacted by Congress during the Sarbanes-Oxley Act. Now, how a company presents on a balance sheet their varying different types of current liabilities really comes down to a preference in the company. They can list them in the order of maturity. So, this is the point at which they expect those to liquidate preferentially. It could be the descending order of amount. So, it could just be this is our largest, going down to this is our smallest. Or it can be their preference of order of liquidation. And this is, although this has a maturity date of 6 months out from now, we really prefer to have extinguished this debt in 2 months, so it's going to come up higher in the list. This is the company painting the picture using their preferences, their strategies, and how they want to show you their information. It is one of the areas where you do have uh, some level of choice when it comes to presentation. Just keep in mind that the supplemental info, the notes, and the disclosures are going to have all of that extra information that is needed to meet full disclosure and transparency in regards to your variety of current liabilities. Now, we did talk about the short term obligations that were in the process of being refinanced. If there is an exclusion of a short term obligation because of refinancing and it has been reclassified to a long term obligation, we should have this type of information in the notes to the financial statements. There needs to be a general description of the financing agreement, recognition of the refinancing if it has already occurred, the terms of any of the new obligations that were incurred or are going to be incurred. And if it was refinanced through an equity issue, as we demonstrated in that particular lecture, the terms of any equity security that was issued or is going to be issued. You want to provide that information in the manner of full disclosure. In addition, sometimes you will find additional charts, supplemental information, and financial statements that describe why. So you see here we have notes payable refinanced in January 2018 and tells us to go to notes 1. In this particular instance, on January 19th, the company issued 50,000 shares of common stock, and they received proceeds totaling uh, $2.385 million, of which $2 million was used to liquidate the notes payable that matured on February 4th. Accordingly, such notes payables have been classified as long-term debt on December 31st, 2017. Is classified as long-term debt for the December 31st, 2017 balance sheet because it was refinanced using an equity issue and was not satisfied using current assets. Now, we're going to discuss contingencies pretty lengthy when we're in class together, but when we want to talk about the presentation of contingencies, with contingencies, there's a level of uncertainty that is attached to them. Distinguishing between current liabilities and long term debt is really important, generally, as a factor, and taking into account probability and estimability when it comes to contingencies is really important. So when there is both a probable and an estimable factor to a contingency, we actually record it in the accounts. So it then becomes a part of the full financial statements. It is inside the balance sheet. However, if both of these requirements are not met, or there is now a reasonable possibility of having incurred a liability, we put disclosure in the notes. And the disclosure in the notes applies not only to those that we have a higher degree of uncertainty with, therefore, they're not in the accounts, but also includes the disclosure of what is in the accounts. This disclosure should include one, what is the nature of the contingency? Is it an assurance? Is it a warranty? Is it a legal issue? Is it an environmental issue? What is causing it? And then an estimate of what the possible loss of or the range of loss is going to be. Many times when we're entering into a contingent situation, we may not have an ability to estimate yet. We may not even have a really good picture, so we're in a range. We're in the 1 to 2 million. That's a pretty big range, but you do want to disclose that there is a $1 to $2 million possibility of loss. Keep in mind that gain contingencies for conservative purposes are not disclosed in the notes, nor are they accounted for in the accounts typically. And the reason for this is because there is a level of uncertainty on receiving that. In interest of conservatism, we look at it from, we will recognize the potential losses if they are estimatable and they are probable. But as far as the gains are considered, we'll kind of take those as icing on the cake if they do fulfill and they do happen. Because contingencies are very often a what if. It's what degree of what if is the company sitting in on whether or not we're recognizing it in the accounts or we are just disclosing it in the notes. Now, regarding those actual contingent liabilities, um, if these other types are in play, such as a company is a guarantee to the indebtedness of the other, so they are a signer, they are guarantor on a loan, they should disclose information on those. If there is an obligation of commercial banks under standby letters of credit, that should be disclosed. And any guarantees to repurchase receivables. We talked a little bit about repurchase agreements back in ACC 211. Um, so you would definitely want to disclose if there is a guarantee to repurchase receivables. Remember, this has to deal with the factoring, or if there's repurchasing in regards to inventory or something else along those lines. Here you're looking at basic notes in regards to potential contingencies and the litigation for Raymark. Um, Here we're talking about they're a defendant or co-defendant in some lawsuits, what the nature of those lawsuits are, in this case, wrongful death, injury and or death from exposure to asbestos fibers in the air. And then here we have a variety of the activity that has occurred in regards to to these particular lawsuits. On here, the company seeking to reasonably determine the liability currently, but they can't predict which theory will apply, and the number of lawsuits that are still to be filed. This happens a lot of times, especially when something large has happened, that there's a degree of uncertainty on how many of your consumers or customers might actually eventually file. So they really don't have a good idea at this point what the cost of settling and defending uh, the current group of lawsuits is, and including the complete unknown factor and variable of unknown and not yet filed lawsuits. Or what the impact will be on the consolidated financial statements. However, they are making the users aware that this is a situation that is ever evolving and currently occurring. Now that we've talked about a lot of different current liabilities, we have talked about how they're presented on the balance sheet. Just kind of want to touch base with you just a little bit more on the importance of looking at whether it's a current liability or it's long term debt. This is especially in those current liabilities that are going to be refinanced as long term debt, and taking into account why having an accurate analysis is important. So we use our current assets and our current liabilities to factor into several ratios. Here up on your screen, you have the current ratio and the acid test ratio. They're certainly not the only liquidity ratios that we use, but they are two of the key ones that are utilized by analysts when they're looking at an organization. If we were to misclassify something into a current liability that should actually be a long term debt, then we would impact and show that the company is less liquid than it really is. Less liquid companies can be determined to be potentially a little riskier. They may not have the same level of reactionary ability when it comes to investments or embracing opportunity. Keeping in mind that the financial statements are the primary means of communicating with all of the varieties of users, and they are also the information that is published to the public. Often we will use the current ratio, which is current assets divided by current liabilities. However, there are some limitations to the current ratio because it just basically lends equal weight to all of the current assets and assumes that they're all highly liquid. This may not be the case in some receivables, or this may not be the case with regards to varieties of different types of inventory. Those are a little bit less liquid than some of the other types of current assets, which is why, for example, in this exact situation, we're looking at current assets divided current liabilities, providing a current ratio of 1.41 times for Best Buy. However, if we consider that their inventory may not be as liquid or easily movable as, say, cash, short term investments, or even their accounts receivables, and we only look at what we call the highly liquid current assets, and then we divide that by the full level of current liabilities, now it's only 0.57 times. So there is a vast difference between the current ratio and the acid test ratio for Best Buy. This is not a surprise. Best Buy is going to have a large quantity of inventory. They are a retailer. But it does paint a little bit more of a grim picture and does paint a more realistic picture, because without carrying their inventory, Best Buy would not be able to generate any revenue. So they cannot scale that down too far uh, because it is their primary means of business. Now, it's interesting, and I want you guys to spend some time reading and thinking about this, is the "What do the numbers mean? I'll pay you later" section in your book and in these slides. So basically, what this talks about is that those giants that are able to control their supply chains have over time really pushed out their terms. So although they look less liquid, they may not actually be less liquid. Um, it is giving them the ability to utilize current assets or cash for other things such as repurchase of stock, restructuring, could be adding and building on in growth, additional other factors that are part of their strategy. So it's not just what is their liquidity, but what is their strategy and why are their current liabilities what they are? Why is notes payable at the level it's at? Is it for a specific reason? Are they leveraging and basically using the financing of their suppliers in order to allow them to free up cash in order to do something else? For those of you that are in the 312 section, be sure to read and be familiar with the IFRS insights that are at the tail end of this specific chapter. It's going to talk about the similarities and the differences. As we can see here, uh, we do have to segregate current from non currents. However, how they're presented is a little bit different. The basic definition is the same, but the contingency issues, that is a little bit different. And then keeping in mind, although both do prohibit the recognition of liabilities for future losses, the IFRS permits recognition of a restructuring liability if they have committed to a restructuring plan. So the recognition of liabilities for future losses, prohibition is more like future internal losses, not we're being sued losses. So just be familiar with what these are, work your way through it in a PowerPoint presentation. That way, when you come to, this IFRS self-test question, play the slides so that you can say a provision is the same as, and then after you make your guess, you can see if you are correct. Again, just a reminder, we will cover the contingencies heavily in class versus doing that a little bit more remotely, how we're doing this, just because they are kind of an area where you really need to develop a good understanding. I want us to discuss them. Let's bring your various experiences to the table because you have merit and value, and the things that you've heard, seen, or experienced may help make contingencies, whether they're warranties or guarantees or self insurance, more relatable and applicable in practice for somebody else.